Hello students, let us look at a novel idea of insurance business, that is microinsurance and rural insurance businesses. The objectives of the lesson are to discuss the need for the microinsurance, social and rural insurances, provide inputs about the regulations issued by the IRDAI in connection with the obligation of the insurers toward the rural areas and social sectors. Provide inputs about the meaning and concept of the microinsurance, rural areas and social sectors, economically vulnerable groups, and targets notified by IRDAI for the next 10 years. Introduction to microinsurance. In order to involve the insurance companies in protecting the micro-financial institutions, self-help groups and the property involved therein, which is required to achieve the objectives of the country. The IRDA has conceptualized the special category of insurance model known as the microinsurance. Microinsurance refers to protection of assets and lives against insurable risks of target populations such as micro entrepreneurs, small farmers and the landless, women and low income people through formal, semi-formal and informal institutions. Microinsurance products are bundled with the microfinance, credit and savings and assets created by the microfinance. The IRDA has framed and notified microinsurance regulations on 10th November 2005 and revised notifications are issued on March 13, 2015 under the powers vested on it via sections 114A of the Insurance Act 1938 and 26 of the Insurance Development Regulatory Authority Act 1999. The insurance companies are directed to make innovative insurance products to meet the needs of the people involved in the microfinance. The microinsurance coverage is targeted to low income groups within irregular and unstable income patterns. It also covers the assets purchased or acquired with the microcredit, personal accident, health and life risks. The IRDA has planned 3-tier strategy approach to promote the microinsurance. Adopting insurance companies to the requirements of the microeconomy is the first step. Then linking them as a wholesale institutions to self-help groups as retailers, and finally upgrading self-help groups, that is to the level of financial cooperatives or village banks. Salient features of microinsurance products. The prime object of microinsurance is to protect the rural poor, bringing awareness among the rural poor about the risk management techniques, developing network of collecting the premiums and claim settlement. The IRDAI has planned to involve the government and non-government agencies to promote the microinsurance concept across the country. The regulations are also aimed at capacity building and having tie-ups between the general and life insurance companies. These regulations contain the provisions relating to insurance product designing, coverage under each class of insurance product, appointment of microinsurance agents, collection of premium in a flexible manner, commissions payable to the agents in the first and subsequent years. Microinsurance policies. Microinsurance business includes sale of various microinsurance policies describing the products. Microinsurance policy means an insurance policy sold under a plan which has been specifically approved by the authority as a microinsurance product. The micro insurance product includes a general micro insurance product or the life insurance product, proposal form, and all marketing materials in respect thereof. Thus, the insurance product, whether the life or general insurance, includes the proposal form which is used to provide the basic information about insurance policy, purchaser, all the marketing promotional information and literature which explain the products and any other information which is relevant to the insurance product which is being sold or marketed. The life micro insurance product means any term insurance contract with or without return of premium, any endowment insurance contract or health insurance contract with or without an accident benefit rider, either on individual or group basis as per terms stated in regulations. The type of policies and coverage available under the life insurance business are term insurance policies with or without return of premiums, endowment insurance policies and health insurance policies. These policies may be issued to cover families and or individuals with accident benefit riders. The application of the micro insurance is based upon the family as a unit, and the family consists of husband, wife, dependent parents and maximum 3 children. Under the term and endowment policies, the risk coverage is available for minimum and maximum periods of 5 and 15 years, whereas the health insurance policies cover the risk for a minimum period of 1 year and maximum period of 7 years. The minimum eligible and maximum age limits for purchasing a term endowment and health insurance policies by an individual is 18 and maximum 60 years. The accident benefit rider may be added to such policies and cover the risk during the continuance of such policies. The micro insurance institutions also issues general insurance products which include to cover the personal belongings of the individual or families, their livestock, huts, tools, implements. These policies are issued to cover personal accidents either on individual nature or in a group mode. The group should have minimum 20 members to cover the risk under general policy. The policies can be issued either in the name of a family, under the family policy or as a floating policy without mentioning the names of the family. The general insurance policies are short-term policies are subjected to renewal. The minimum amount to cover the asset is rupees 1 lakh per asset, and the coverage including the crop insurance is available to 1 year. The policies covering the health insurance policy be issued up to rupees 2,50,000 per group and rupees 1 lakh per individual, and accident coverage is available up to rupees 1 lakh. The policies discontinued may be revived with the payment of nominal amount as specified by the regulations. There is no age limit for the group insurance policies to cover the families and their assets, whereas the accident policies are issued to cover the ages in between 5 years and 70 years. The premium has to be paid in advance as per the provisions of Section 64 VB of the Insurance Act 1938. It may be payable in weekly or fortnight mode in addition to regular mode of payment such as monthly, quarterly, half-yearly and annually modes. Issue of micro insurance products. The micro insurance products include the general and life insurance products. The general insurance products include the insurance contracts which cover the health insurance, covering the belongings such as hut, livestock, tools and instruments, or any personal accident policies either covering the individual or groups. The life insurance products include the products designed according to the guidelines given in the regulations. The insurance company dealing in the micro insurance may issue the life and the general insurance products. The life insurance company and general insurance companies may enter into tie-ups for marketing of the general and life insurance products by them. The tie-up may be at the level of products and for marketing and distribution of products. After the tie-up agreements, one company acts as an agent of another company which is not in practice in marketing of other insurance business. The company issued the micro insurance, general insurance product or the life insurance product. When it receives the claim, has no right to settle the claim of the other company. They forward such claim to the concerned company and cooperate with it in settlement of claims. The responsibility of collecting the premium from the proponent lies with the company which is marketing the product, but not with the company which is issuing the policy. The tie-up agreement with specifically mention the responsibilities of each member of company involved therein. Micro insurance agents. The micro insurance products are distributed with the help of marketing agents. The agents who market the micro insurance products are known as the micro insurance agents. The Micro Insurance Regulations 2015 permits appointment of micro insurance agents and permit all the agents and brokers having valid insurance license under the provisions of the Insurance Act 1938 to market the micro insurance product. Micro insurance agent means and includes non-governmental organizations, that is NGOs, self-help groups, that is SHG, and micro financial institutions, that is MFI, who is appointed by the insurer to act as micro insurance agent for distribution of micro insurance products. The appointment of micro agents is by way of an agreement between the insurance company and an agent. Under the agreement, the insurer may authorize the micro insurance agent to undertake any function relating to the micro insurance product, such as collection of proposal forms, declarations, premium payments, and distribution of policy documents to the purchaser. They also help in filing nominations and maintenance the registers. The agents also help in settlement of the claims. The agent should maintain the records of the purchase of the micro insurance policies. The agents have no right to underwrite the micro insurance policies, and the insurance companies have no power to grant such rights to the underwriting the policies in favor of the agents. The regulations also reduced the requirement of training hours to the agents to 25 hours. The training has to be imparted in the areas of insurance selling, policyholder servicing, and claims administration. They have the right to appoint specified persons with the prior approval of the insurers to discharge all of or some of the duties of the agents under the regulations. The agents strictly follow and adhere to the code of conduct specified in the regulations. The agents will be paid remuneration as per the directions of the IRDA and stated in the regulations from time to time. Obligations of micro insurers. Every insurer shall follow the rule of file and use of the micro insurance product. The product so approved should carry the title on its as micro insurance product. No insurer can sell the micro insurance product unless the product is approved by the authority. Every insurer should issue the micro insurance products in vernacular language which is approved by the Constitution, in easy language which can be understood by the policyholders without any difficulty. If the policy cannot be issued in vernacular language because of any valid reason, a write-up explaining the facts and content of the policy in vernacular language has to be enclosed along with the policy. If the policies are issued to cover the groups, a schedule containing the details of the persons covered under the policy has to be attached to the policy. In addition to the same, a certificate of insurance describing the cover of the insurance has to be issued to every individual of the group. The certificate should contain the details of the cover available, names of the nominee, tenure of the policy, details of the office of issue of the policy, and details of the office of the service. Every insurance company has to maintain their own mechanism to settle the issues, problems, and the grievances of the policyholders without any delay. Every insurer has to submit the information to the IRDA in prescribed form and manner. Insurance companies have advantage in participating in the micro insurance business. The business undertaken by them can be recurrent for the purpose of fulfillment of social obligations by the insurer in accordance with the provisions of the Insurance Act 1938 and regulations made by the IRDA. The micro insurance products sold in the rural areas will be covered under definition of the social sector and can be recurrent under the both rural and social obligations. Social and rural obligations of insurers. The IRDA has established with one of the objectives of the spreading the insurance concept to the rural areas and protect them from the losses resulting from the uncertainties such as natural calamities such as flood, drought, earthquake, and other calamities. As part of its moving to achieve its objective, it has inserted section 32B and 32C in the Insurance Act 1938 and imposed obligations upon the insurance companies to underwrite certain minimum business in the rural areas and for people belonging to the unorganized sectors such as farmers, agricultural laborers, self-employed persons, and also rural technocrats. With the powers vested, it has framed regulations and notified in the official gazette in the year 2002, and later fresh regulations are notified on August 24, 2015, which are prevailing now. The objective of these regulations is to spread the insurance business concept and its advantages to the rural areas where majority of people live in poverty. They suffer from economically backwardness. They are considered as underprivileged and unorganized. In order to help them and save them from further losses due to natural calamities or otherwise, IRDA has formed regulations. These regulations prompts every insurance company to undertake the insurance in rural areas and provide insurance business to protect the lives of the socially and economically backward people as they are vulnerable to various economic risks. The Agriculture Insurance Company of India is not provided with the minimum or maximum level business to undertake in the rural and urban areas. They impose certain minimum targets on every insurer to comply whether that particular business is profitable or not. According to these directions, every life insurer has to issue a minimum of 15% of total life insurance policies that has directly underwritten during every financial year after 5th year of issuing of regulations, that is by 2016 and 17. Every general insurer has to underwrite a minimum of 5% of its gross premiums from the rural sector. It also directed to cover minimum 20,000 lives every year by 2016 and 17. At the time of framing these regulations, the concept of microfinance is reaching the rural areas slowly. the importance of insurance is not understood with reference to the microfinance activities. Most of the concentration was on educating the rural people in forming the self-help groups and empowering them to undertake some of the business activities. As such, there was no thought at that time to link the insurance concept with that of the microfinance concept. All the insurers who are in life insurance operations have designed products to meet the needs of rural and social sector obligations. Subsidies for the insurance cover are provided for the power looms workers, handicraft artisans, and handloom weavers. And claim settlement is also another important problem in addition to the collection of premiums. In some cases, the rural people who are not covered under the categories stated under regulations leading to the obligation of insurers to rural and social sectors. The microinsurance has a complementary role in the growth of rural insurance business in addition to the role played by the insurance companies under the compulsion of IRDA regulations. The microinsurance regulations is focused on the individuals and families. The family is a unit under the regulations. It concentrates upon the economic status of the family and tends to protect them. This obligation also includes other people who are not gainfully employed. The microinsurance is applicable to all the class of the people undertaking the business activities at the micro level. The Microinsurance Regulation 2015 are silent on the operational locations, but regulations relating to rural are applicable to those people who are living in the rural areas. These obligations in addition to the rural areas are applicable to urban areas with reference to social sectors and unorganized sectors. Obligations of insurers toward the rural and social sectors. Section 32B inserted in the Insurance Act 1938 by the Insurance Regulatory and Development Authority Act 1999 imposes an obligation on every insurer, general and life insurers, to undertake certain minimum business to the underprivileged sectors of the society and people in the rural areas. The IRDAI shall indicate the minimum requirement of business in these areas and notify in the official gazette. Section 32C of the Act further states that the insurers in general and life insurance sector shall undertake certain level of business as stated in the notifications issued by the IRDAI to the policies to the persons in rural sector, workers in the unorganized or informal sector, or for economically vulnerable or backward classes of the society and other categories of persons. The IRDA has issued regulations in the year 2002 for the first time and given the targets to be accomplished within a period of 5 years. The IRDA is empowered to revise the obligations on regular basis periodically and give directions to the insurers for achieving the specified targets. Accordingly, it has issued the revised guidance in the year 2015, which are effective from the financial year 2016 and 17 for a period of next 10 years. Insurance Regulatory and Development Authority, obligations of insurers to rural and social sectors, Regulation 2015. IRDAI, while exercising the powers conferred by the Insurance Act 1938 and IRDA Act 1999, and with reference to Section 32C and 32B of the Insurance Act 1938, in consultation with the Insurance Advisory Committee, has made the regulations with regard to rural insurance businesses. It made the regulations known as IRDA Obligations of Insurance to Rural and Social Sector Regulations 2015 and imposed a duty on every insurance company operating in India to undertake the insurance business in rural areas and for the benefit of the social sectors who are deprived of the same because of various age-long reasons. The regulations define the rural sectors as the areas which have been classified as rural while conducting the decennial census. Earlier, the regulations 2002 have defined the rural areas as the places where a population of not more than 5,000, a density of the population of not more than 400 per square kilometer, and at least 75% of the male working population is engaged in agriculture. However, this definition is omitted in the new regulations. These regulations define the social sector to include unorganized sector, informal sector, economically vulnerable or backward classes, and other categories of persons both in rural and urban areas. And similarly, unorganized sector is defined to include self-employed workers such as agriculture, laborers, BD workers, bricklaying workers, carpenters, cobblers, construction workers, fishermen, hamalis, handicraft artisans, handloom and khadi workers, lady tailors, leather and tannery workers, papad makers, powerloom workers, physically handicapped self-employed persons, primarily milk producers, rickshaw pullers, safai karmacharis, salt growers, sericulture workers, sugarcane cutters, tendu leaf collectors, toddy tappers, vegetable vendors, washwomen, working women in hills, or such other categories of persons. The economically vulnerable or the backward people include the people who live below the poverty line. The informal sector includes small scale self-employed workers, typically at low level of organization and technology, with the primary objective of generating employment and income with the heterogeneous activities such as retail trade, transport, repair and maintenance, construction, personal and domestic services, manufacturing, with the work mostly labor intensive, often unwritten or informal employee and employer relationships. Every insurer who carries the insurance business after the commencement of IRD Act 1999 has to ensure that obligations towards rural and social sectors for the financial year starting from 2016-17 are fulfilled. Rural sector. In respect of life insurers, the insurers should issue 7% of the total policies underwritten in the rural areas and thereafter 9% in the second financial year, 12% in the third financial year, 14% in the fourth financial year, 16% in the fifth year, 18% in the sixth and seventh year, and 19% in the eighth and ninth years, 20% in the 10th year and thereafter every year. In case of general insurance business, the percentage of gross premium underwritten direct or to be allocated to the rural areas, first year 2%, second year 3%, third year to seventh year 5%, eighth year 6%, ninth and every thereafter 7%. The 50% of the total general insurance business undertaken for the rural sector should have towards the stand-alone health insurers. In case of the social sector, the obligation insurer should have a minimum coverage of people in the social sector, which is 0.5% of the total coverage of the business and should have incremental increase of 0.5% of lives every year and should reach 5% by the end of 10 years for further period. Every insurer under an obligation to submit the returns and reports on the business they undertook in rural areas and social sector people. The IRDA has the right to undertake and notify the changes wherever and whenever required. Students, this gives us a view of the meaning and concept of the microinsurance and various obligations imposed by the IRDA on life insurers and general insurers operated in India towards upliftment of people at rural and social sectors.